Hello, I'd like to welcome everyone to Capital Link Shipping Sectors webinar series. I am Liam Burke, and today's webinar is on the LNG sector, discussing the sector trends, developments, and outlook. Our discussion will be sector focused. I'll moderate this discussion, and we're privileged to have with us key industry leaders who I will introduce shortly, but two quick remarks. These webinars are for informational and educational purposes only and do not constitute investment advice of any kind. You can submit your questions during the session using the button at the bottom of the screen or email them to Capital Link at questions@capitallink.com. These questions will be addressed at the end of the panel discussion. And again, please limit the questions to a sector focus. With that behind us, let me introduce our panelists today. Mr. Nicholas Gleeson, Chief Financial Officer, ADNOC Logistics and Services.
Thanks very much for the introduction. Very glad to be here today.
Thank you, Nicholas. Mr. Jerry Kalogiratos, CEO of Clean Capital Energy Carriers Corp. And last but not least, Mr. Oystein Kalleklev, CEO of Flex LNG. Welcome, gentlemen, and thank you very much for your time, and I'm looking forward to our discussion. So let's start out with the obvious here. We're in what should be a seasonally strong fourth quarter. Charter rates on either a relative or absolute basis are at rock bottom. Understanding that there are some exogenous influences here, could you give us your best view as to where you look at the medium and long-term place for rates as we get through this rather choppy period? If we could start with Jerry, I'd appreciate it.
Thank you, Liam. Good afternoon, everybody, and thank you, Capital Link, for hosting us today. Liam, today we have a challenging short-term market for sure, and it's on the back of a number of factors. The major factor I would describe as delivery timing a mismatch. In reality, we are awaiting for a number of new liquefaction projects to come in line in 2024. Almost half of that capacity has actually come online, and a big part of that is also related to Arctic LNG 2, which, as we know, faces its own challenges. At the same time, we have had 50 vessel deliveries this year, and more expected by year end or early next year. And this, combined with high commodity prices in Europe for the molecule, meant that there is little incentive for long-haul cargoes. And at the same time, there is a number of Asian buyers that tend to be quite price sensitive, and hence that kept a lead on the demand from the Far East. While it seems that we will continue to see a challenging market ahead over the next few months as we continue to see delays in certain projects, such as Golden Pass or Rio Grande. The forward pricing continues to point that the marginal cargo will be coming into the European Union, and hence that has also incentivized a number of charterers that are long shipping to relet the vessels at almost any price in the market. So this has put a lot of pressure in the short to medium term market. But overall, I think there is a silver lining to that, and maybe we'll come to it later, that will start pushing other vessels out. And that will be, I think, also part of the path to recovery, as we see eventually the startup of projects that are under construction, as well as new FIDs that will be boosted by the incoming Trump administration. We expect that the market will recover. If anything, we don't think it's a question of when, of if, but of when. Together with the supply rationalization, so all the technology vessels being removed and the new volumes coming online, we expect a much healthier market longer term from 2026 onwards.
Thank you, Jerry. Oystein, how do you look at, I mean, we've gotten the background and Jerry has given us a lot of reasons why the rates are under pressure now, but how do you see them rolling out medium, long term?
I think I totally agree to what Jerry said, by the way. Too many ships, not a sufficient good enough arbitrage to Asia, given that Europe is utilizing a lot of gas recently. And also you don't have intramont arbitrage, meaning that there's really no incentive to float the cargoes. So there's no incentive to have floating storage, which ties up a part of the fleet this season. So in general, what we have said is also that we think the market is oversupplied with ships near term. And of course, we have taken that into account when we have our chartering strategy. We just announced recently 3 new contracts, extension of 2 ships from 29 to 32, possibly to 2039, and then 1 ship from early 2026 all the way to 2041, a 15-year contract. So we had 1 ship delivered back this year from a term contract. We were able to find a new term contract for that ship because we didn't want to have any spot exposure this year because there's just simply too many ships. And this will take some time to grind through this oversupply of ships. And I think next year also there's too many ships. And then, as Jerry says, from 2026 onwards, you will see gradual improvement in the market balance. And what we have said is that we basically want to push our ships, have coverage to 2027 onwards, where we think the market will rebalance. And this rebalancing will also entail scrapping of older ships. There's been a lot of steamships coming off charters the last couple of years, but the market been so buoyant during 2022 and 2023. There's really not been any incentives to scrap older steam turbine ships. But with the market poor now, the silver lining, as Jerry mentioned, is the fact that you will see a huge uptick in scrapping of older steam turbine ships, which are not efficient. They are not too small. And then gradually we'll see an improvement in the market balance, which means rates will stay low near term. But given the elevated price on new buildings, we do see that new buildings, in order to have an economic incentive to contract new ships, you really need to have long-term rates in the 90s, which is significantly higher than what the rates are today.
Well, you've given me a nice overview of my next 3 or 4 questions, so we're going to go into a little depth there. But first, Nicholas, I think we've agreed that the short-term pressure on rates will be alleviated over a period of time. Oystein touched on what they're doing in order to get from here to there. Could you give us a sense as to what your fleet strategy is in light of what we all agree to be inordinately low rates that won't last forever?
Yeah, so absolutely, we agree with everything that's been said so far. And I think, some key points there. If you look at the price for a new build and the availability of a new build, by the way, as we get towards what's likely to be the very strong period, late 26 and beyond, availability is very tough and the pricing is at all-time highs for new vessels. So for us, the strategy has to be very much around long-term contracting of those assets that we make new investments in. I definitely agree with what Oystein is saying. I think we'll definitely see some of the steam turbine fleet leave the market. I think, there's more than 100 coming off contract in the coming years, and it's very likely that we'd see at least half of that. We're already hearing of assets being held available at the moment for scrapping, so that will help to take capacity out of the market. I think we definitely see demand shifting from Europe towards Asia, significant growth in ton-mile demand, the potential for even further volumes to come out of the US, given the change in leadership. So I think we see that shift towards strengthening rates, but still for us, with asset prices where they are, we've been very heavily focused on long-term contracting of those assets. So, we've added 340 years of gas contracted assets this year. We have 8 new LNG new buildings ordered for delivery 28, 29, all of those going on to 20-year contracts. And we had 6 that were already ordered. The first of those is delivered, and 5 of those 6 go on to long-term contracts starting from the mid of 2026. So we do see, an interim softness. But thereafter, we see, strong contractable rates into the long term, given the dearth of new tonnage coming into the fleet, given the high pricing on new assets being built in 2028 plus, and giving the assets that we see coming out of the fleet in the next 3 to 5 years.
Great. Thank you, Nicholas. Jerry, can I jump to you and just talk about your fleet strategy for a moment? Both Oystein and Nicholas have touched on it, and I want to just throw it back to you on where your fleet strategy is and where you want to go with your core assets.
Thank you, Liam. I think similar to my fellow panelists, we have de-risked the short term, so we have no exposure to this market with 12 latest generation vessels in the water, with an average remaining charter duration of more than 7 years and about 2.4 billion of contracted revenue. I think we are very well placed. And importantly, because we do believe that we are going to see much tighter markets ahead, we have also 6 additional vessels, LNG carriers, coming from 2026 and 2027 onwards. As I think the market recovers, we will be very well positioned to capitalize on that recovery. That's, of course, in addition to the 10 LPG and ammonia carriers that we have. Effectively, there is definitely a correlation, especially when it comes to the LPG business. And with an incoming administration that has clearly said that it's going to be quite favorable to drilling and gas exports, I think we will be very well positioned to take advantage of this.
I guess I'll ask Oystein and Nicholas a question. I guess starting with Oystein. Do you have any strategy to leveraging your core fleet into other areas of gas transport other than LNG?
No, what we are focused on in Flex is LNG ships, and right now with the new contracts, we have 64 years of minimum backlog. That's on average 5 years each ship, with option that can actually increase to 98 years. We only open ship. We have one ship open Q2 to Q1. So Q2 25 to Q1 26 before that enters into a 15-year contract. So the next fully open ship is 2027. And then we have ships coming open 27, 28, 29, where we think the sweet spot will be. Also now with Donald Trump, it seems like he already started his presidency, but with kind of the moratorium being lifted in the US, we also see a lot of more impetus for more growth from the US market. Other segments, not really. I've been running another shipping company on the side, Avance Gas, where we've been involved in the LPG and the ammonia segment. We started that year with 20 ships. We announced we sold all the ships this year. So by end of the year, we probably have 0 ships in that company, and we rather focus on dividends instead, and where we're paying out all the money back to shareholders as quick as possible. So for Flex, it will only be LNG.
Great. Nicholas, could you round this one out?
For sure. So we have a fleet of 6 VLGCs in joint ownership with Wanhua Chemicals. They're on long-term contracts, so we're very happy with that fleet. We've also recently invested in 9 very large ethane carriers delivering over the next few years. All of those, again, delivering to long-term contract. The same kind of strategy there is building our position in the market where we see likelihood of growth in that large-scale ethane transportation market, and positioning ourselves with a significant early fleet against long-term contract to be ready for that market to grow. And on the same terms, I think very large ammonia carriers. So we've invested in 4 new build very large ammonia carriers. Now those aren't long-term contracted yet. The market really isn't there for long-term contracts on those assets. But again, we're positioning ourselves for what we think will be a new growth market in gas, and to be ready as that develops.
Great, thank you. We did touch on long-term contracts. When negotiating a contract, there's always a trade-off between rate and duration. I guess I'll start back with Nicholas. How do you think about the trade-off between rate and duration? Do you want to lock in those cash flows based on the price of the asset, or do you want to leave some room to generate upside rather than taking this thing 30 years as a fixed pipeline?
Well, we do both, but we place a lot of value on long-term fixed contracts as long as they meet our minimum hurdle rate for unlevered internal rate of return. The reason we think about it like that is those long-term contracts act like an annuity. They give us a really strong cash flow base against which we can then afford to take risk in asset classes where we think that adds value. So, we're willing to slightly lower our view on required rates of return against a longer term contract, just because of that security that gives us to continue to grow the rest of the business in areas we think are valuable.
Gary?
I think it's a quite similar strategy in we want to have those long-term contracts and the underlying cash flow generation, but at the same time, you want to have exposure in the market. One thing that we put a lot of emphasis on is having staggered expirations. You don't want to have all your eggs in one basket, and I think we have achieved this quite well. Right now, we have for example, the new builds being delivered in 2026, 2027, and one charter expiration at the end of 26. But then really we have staggered expirations of our existing fleet from 28, 29 onwards. So I think the idea is locking in some of those long-term charters opportunistically, but at the same time, keeping always some exposure to the market.
Great. Thank you, Jerry. And Oystein, do you have anything to add?
In general, for us, we started off as a speculative shipping company. We ordered 13 LNG carriers on speculation, took delivery of those in the window 18 to 21. We built up our in-house ship management, which got kind of the license in 2019, and we thought we were very well positioned to start fixing out ships on longer term charters in 2020. But then COVID happened, and our strategy was a bit derailed. We traded spot through the whole of 2020 and actually made some money on that, believe it or not. But then once the market came back in 21, we started fixing ships on longer term contracts. 2022, when gas prices went sky high, equivalent to $600 per barrel of oil, we added 38 years of backlog just in that year alone. This year, we added 27 years. So we have been opportunistic, and generally, of course, you want to start contract negotiations when market is high, meaning spot rates are high, which are dragging up term rates, because then you can find good tenor and good rates. Right now, of course, with the market slumping last couple of months, also the kind of the negotiation power for finding good contracts is a bit harder. But this will come back. This is shipping. It's always like this. You go from oversupply to undersupply, and as I said, I think the market will rebalance by starting off in 2026, and we're getting into a better market 27, 28, when most of our ships are coming open.
Great. Thank you. Thank you, Oystein. We touched on steam-powered carriers, the potential for scrapping. Just this month or late last month, it was the first on-block recycling of 4 steam-powered LNG vessels, which, typically they always go in one at a time. So I mean, generally we always hear about scrapping being the great savior of overcapacity, and it just never seems to occur. There's always some reason why somebody is trying to squeeze extra life out of that asset. But this seems to be a little different. This is the first time we've seen, 4 go in at one time. Is this the beginning of an accelerating trend where we're going to see a measurable shrinkage in the steam turbine LNG carriers? I guess we'll go back to Oystein on that.
Yeah, for sure, it's happening, and it's not only about market slump now, it's also about regulation. So think about it, steam turbine. How often do you hear about steam turbines these days? So, I went to this university in Scotland, Harriet Watt, named after James Watt, to improve the steam turbine. So it's a long time ago, and every other shipping segment have left steam turbines a long time ago because they are inefficient. But for some reasons, technical reason mostly, you have had this in LNG shipping, while the modern ships today have a modern diesel engine that can burn LNG. So it's about the market correcting now, which means they don't have incentive to kind of take them through the service cycle. So every 5 years there's a service cycle. It costs more money when you have these older ships. It's also about the size of the ships. It's subscale. And then, of course, when they're inefficient, they're using a lot of fuel, and there are certain IMO regulations coming in place for this, where kind of these ships are being penalized. So it's not only about economics, it's also about the technical aspects and the environmental reasons, and no big charters want to have these ships in the portfolio. So once they are rolling off contracts, and these ships were typically contracted against 20-year contracts, so once they are rolling off, they are not renewed, which means they can come back in the spot market, and the spot market was quite good in 22 and 23. So those ships were not scrapped. But now, as Nicholas also mentioned, 100 of these ships coming off charters now the near term, and these ships will leave. And actually still you get fairly good price on steel. So we think that there will be a big uptick in scrapping, and you will really have the first big scrapping cycle in LNG shipping.
Jerry, that was pretty comprehensive, but again, I'm always wary of those assets staying out there longer than they should. Is there any reason why you would see that this trend of recycling won't continue and not have somebody figure out a way to squeeze more return out of these obviously inefficient assets?
Yeah, I think the difference is also, unlike other shipping segments, that the carry cost for these vessels is quite high. So it's not as easy to stay idle, because just staying idle with the boilers on means that you are probably, together with OPEX, you're between $30,000 to $40,000 per day in the red every day. And then given that quite high consumption of these vessels. But then if you decide to go either the warm or cold layup avenue, there you have a lot of hidden costs. So you might decide that you want to wait it out and switch off those boilers and take some crew off and reduce your OPEX and your energy consumption as you wait. But then once you decide to reactivate, especially if we're talking about longer periods, say 6 months, then suddenly you have to face reactivation costs that are quite costly. In certain cases, you will need dry dock. And we're talking from anywhere between $1 million and $2 million. And then if as more time goes by, especially cold layup in certain areas of the world, then that cost maybe 2 or 3 times what I just mentioned. And of course, then you have special surveys due, and these are very costly exercises for steam turbine vessels. Often it is the case that you cannot find spares anymore because these are obsolete assets. So I think you will see increasingly more vessels that will, as owners go through this calculation, they will choose to scrap today rather than bleed over the next few months. The recent transaction that you mentioned, I think it's quite typical of what you should expect going forward. And if you scratch the surface today, you'll find that at least 15 to 20 vessels that are trying to find a home. Some of them might go into FSU or FSRU conversion, but there is so many projects. Really, with steam turbine vessels earning $20,000, $30,000 and TFDEs, even single digits for a period business, there is really no place for steam turbine vessels. And I think increasingly many owners will take the decision to scrap. And don't forget, many of these vessels, they have been paid down quite already. They come off 20, 25-year charters. They have fulfilled their role, so it's not a huge decision.
Just Liam, I'm just going to give you a practical example. I'm a bit more than 7 years. I left my job in the Knutsen shipping company. There was 2 LNG shipping ships outside my window in layup. This is more than 7 years ago. They are still there today. So even though you had this boom during 22, 23, those ships were never reactivated because nobody wants those ships. Nevertheless, if the rate was low.
Great. Just a quick follow-up on that, Nicholas. Do you see the scrapping trend, which I think we all are more comfortable with than some of the other sectors, actually helping capacity? Do you see that being able to squeeze the window of capacity improvement before 2027?
So I think it's not going to be the single most important factor. I think it will definitely help. I think really it's the growth in ton-mile demand. It's the timing of new volumes and new projects coming online, particularly what we're going to see in 2025, how quickly that comes online and how much volume comes online, new project growth, and of course the ton-mile demand as we see that shift in routing towards North Asia, and particularly the growth in demand that's coming from India. All of this is, going to be the strongest driver. I definitely do think that we're going to continue to see scrapping at an increasing rate, in these coming months, we anticipate, because it's going to be so hard to justify reinvestment in end-of-life assets at the moment, whereas, for the past couple of years, it's been relatively easy. The incentive's been quite high because the available rates are quite high. At the moment, the spread between the rates on a relatively modern LNG carrier and a steam turbine is pretty low, which is in the nature of being at the bottom end of the market. But then, it's very difficult to see charterers, finding a rationale to employ a steam turbine LNG carrier at the rates today when you've got availability of other assets. So I think we will see a lot of scrapping from the steam turbine market. I don't think it's going to be the most significant driver of retightening of capacity. I think it's really going to be the growth in volumes and the growth in ton-mile demand that drive that shift, but it certainly won't hurt.
Okay, staying with you, Nicholas. Thinking about a new build of roughly $250 million, looking at your view of medium to longer term rates, have prices got to the point where the returns on that investment may be questionable and maybe have shippers hold off on new builds?
Yeah, I think it's definitely going to be challenging to secure contracts at the moment, given where the spot market is at the rates that justify building at $250 million plus for a new asset. Having said that, we've been able to contract long term, against newly built assets simply because of where the market outlook is. And I think for anyone who's looking 10 years plus into the future and understands what's happening in terms of the demand for modern LNG carriers, I do think it's possible to justify those types of rates. And Oystein mentioned before, a 90K plus rate for longer term contracts. And we definitely think that's the case, within a couple of years, that we'll see those rates develop again for longer term contracting. And I think for anyone who's contracting very long term into the future, the rates will go beyond that until we see, some significant additional capacity coming into the market after we see the older end of the fleet leaving the market.
Great. Jerry, could you add a little on what your view is on the return on investment on a potential, we'll call it $250 million new build?
I definitely agree with the approach, although I do think that we will continue to see new building orders going forward. I mean, if you think about it, just very recently we saw a vessel being fixed for a long-term charter, again in the region of 90,000, and then immediately the owner going out and ordering the next one. And we also know that a number of projects and charters that have offtake are expected to come into the market, into the new building market in 2025 and have fairly large requirements for ships delivering in 2028, 2029. In the end, in order for this math to work out, yes, you would need somewhere in the high 80s to low 90s as a minimum type of charter rate for all this to make sense. But I don't think that we will see a dearth of new building orders. I think we will see incremental ships being ordered. We will definitely see fewer speculative orders. But in terms of new requirements, I mean, we have this big order book that we talk about, what is it, 340 ships or so. But then when you see at how many ships are not committed to projects, that's around 28, 27 ships. So there will be incremental need for new builds against projects. People will come to the market, and I think that will also be very supportive of new building prices and hence also for the long-term market.
Right. Oystein, do you have anything to add to that, or?
No, I agree. Okay, the order book is large, but there are very few speculative ships, and of course these high prices are deterring people from ordering new ships, especially where the market is today. So in general, I think it's positive for us because that enables us to remarketing our ships, because we have the same ships. The new type of ships are slow speed two-stroke dual fuel engines. It's the same we have. It's the same generation of ships. And given the fact that new build prices are elevated, and they're going to stay elevated because the yards are packed with orders, they don't see any reason to kind of reduce prices given their earnings visibility, which means that we can recontract our ships. So we just announced that we are recontracting 2 ships from 2029. Those ships on average is 9.5 years then, and we're fixing them for a minimum period of 3 years to 32 with option to 2039, where we can offer basically the same ships, slightly cheaper than our new build, but where we are able then to increase the revenues on our ships because rates have moved up because of the big increase in new building prices. So we do see more charters coming to the market today where they are also open to consider existing ships and not only kind of a new building tender, which is generally good for those people who have the modern fleet.
Right. Staying with you, Oystein, the nature of long-term contracts creates a fair amount of predictable, strong free cash flow. Now, each of your companies has strategies in terms of investment in additional assets, and we've talked about the return. So you have the return. Over and above reinvestment in assets to generate a return, what are your other priorities for capital allocation?
In general, we have kind of what we have today is, of course, this big backlog, 64 years on minimum. And then we have coupled that with a lot of cash, with pro forma cash of $450 million. Gives us a lot of firepower. Hopefully we can, if there is a downturn and some people have some problems, we can jump on those opportunities to grow the fleet. While doing that, of course, we are paying our kind of traditional ordinary dividend of 75 cents per share every quarter, which we have done for quite some time now, and which translates to about $160 million of yearly dividend, or a yield of somewhere around 13-14%. So you get a very nice stable dividend by investing in Flex. And right now with the slump in our share price, eventually it seems like maybe buying the stock back could be at one time the best option for us, because today the implied pricing of our fleet is much lower than going to the yard and contracting new ships. So we have a very disciplined capital allocation strategy. I think we have also evidence that in the other company I'm managing, Avance Gas, where we basically sold off all the 20 ships and returned all the money to shareholders. Said, thank you, now the business is over, and enjoy the dividends.
All righty, thank you. Jerry?
I think we are in a great spot liquidity-wise. I mean, now, and that's in addition to the free cash flow generation of the 12 LNG vessels and our other vessels. I mean, on a full year basis, that should exceed 100 million. That's before the new builds come online from 26 onwards, which is, as I said, the 6 LNG carriers and the 10 LPG, ammonia, and liquid CO2 carriers. So we are in a very good place, and we have our growth built in, which we expect to be fully financed from cash at hand, proceeds from the sale of our legacy container vessels, which we are now delivering to their new owners, as well as, of course, the free cash flow generation of the existing ships. Now, what we have said is that as our new ships deliver, we will move to a floating dividend as a percentage of our free cash flow and the net income. So you should expect more capital to go towards shareholders as we complete this first phase of growth. But at the same time, because of the great liquidity position that we are in for the above mentioned reasons, I think we'll be in a great place to grow further, and we might have to compete with Oystein in the sense that there will be opportunities in this market. Potentially, there's always a player or two that might be distressed, and so there might be opportunities in the second-hand market, or of course the new building market as the new projects come online.
Thank you, Jerry. I know, Nicholas, you're a private company. You've mentioned investment. So if you'd like to add any color, that'd be great, or we go on the next question.
For sure. No, we're a listed company on the Abu Dhabi exchange.
Okay.
We've delivered shareholder returns of about 180% over the last year and a half. So, you know, we're one of the highest growth stocks out there. How we're delivering that growth is by having a really strong focus on developing our core, which is actually our integrated logistics business, on top of the growth that we're delivering through shipping. So we really see ourselves as an end-to-end maritime logistics company servicing the energy sector. A lot of our reinvestment is available against longer-term contracted income. So we love to continue to do that. It gives us a really solid core for that future growth. And a lot of the opportunities that we have for growth are coming from the ADNOC business itself, growing in the Gulf countries, but also rapidly growing internationally, if you look at the announcements they've made over the last few months. And so for us, we're looking at deploying that financial strength we have to continue growing our integrated logistics business internationally, at the same time as we grow our fleet, not only in gas, but also into tankers, oil and product tankers, as well as the growth that we're achieving in dry bulk transportation. So for us, it's all about growth. It's not so much about dividend yield at the moment, because we have a really strong backlog of opportunities to deliver with that incremental free cash flow that we keep growing over time.
Great. Thank you, Nicholas. I do want to add a question from the field because Oystein did touch on it, but I'll start with Jerry, and it's about the incoming Trump administration. The prior or current administration had some very, at least in the U.S., regulations that made it a little more difficult to export LNG. Starting with Jerry, how do you look at the new administration? Does it change anything on the outlook for the development of new LNG projects?
I often joke with investors that if they want to play the incoming Trump administration investment, especially in energy, probably CCEC is the best bet. We expect that the energy sector, and especially whatever is export-oriented, like the LNG business, is going to be favored quite a bit by the incoming administration by lifting the export ban and potentially accelerating regulation. So with us having ships open into 2026, 2027, we are well placed to take advantage of these potential new additions of liquefaction capacity in the US. And, you know, it's pretty significant. Today, current US production is probably around 90 MTPA with another 90 or so under construction. The projects that are pending FID or have been paused is another 100 MTPA. So even a fraction of that materializes, we expect to have quite decent demand for LNG carriers going forward.
Oystein, do you have any additional comments on this discussion?
I generally agree with Jerry. Of course, we had Biden putting in the moratorium in January in order to shore up his base. Now with the new administration, there's a lot of projects ready to go in US once those policies are changed, and the scrapping of this moratorium, which I think is generally good. I think maybe the slashing of all the methane regulation is not necessarily as good for the LNG, and that's why most of the big players actually are against that kind of regulation, because it means like buyers here in Europe will be maybe a bit reluctant to buy US LNG unless they meet certain requirements in terms of emissions. But in general, it's positive, and I expect a wave of new LNG projects in the US being FID'd next year as a consequence of this, which will add more growth to the market from 2028 onwards.
Great. Nicholas?
Yeah, in very simple terms, agree. We're also bullish US exports going forward.
Fair enough. On the macro front, I guess this is a much longer term view than any of us need to think about, but where LNG fits into the global strategy of reducing carbon emissions. Is this a transitory solution to what people want in terms of carbon emission? Or is this a solution that fits in with a group of them, and does it really matter to your business on where LNG ultimately fits into the long-term solution of carbon emissions? I'll start again with you, Nicholas.
Yeah, I mean, you know, from our perspective, it defined transition, right? But it has to be an extremely long-term transition to be sensible in terms of the investments which are required, you know, at both ends of supply and demand, and the transportation in between. And we believe that's absolutely going to be the case. You know, there's it's a cleaner energy. It's a very, very successful transition energy, already proven in many markets internationally, and we believe it has a long-term place in the energy mix that you know underpins the new investments which are being made today.
Oystein?
Yeah, it's never really been any energy transition. It's been the energy addition. Every time we find new hydrocarbons, we just add, and then we add renewables on top of that. Coal is still growing. So of course, LNG is the best way of replacing coal. And keep in mind, people started using natural gas not because of CO2 emissions, it was because of local air pollution. But that said, you know, I do think that longer term, you need to address the carbon element. And there are certain projects doing this with carbon capture for LNG gas power plants. And if you are able to address the issue with the carbon emissions, then it's not really any kind of a bridging fuel, then it's a destination fuel, because once you get rid of the sea, you basically are at hydrogen, left with hydrogen, and you have reduced the pollution, air pollution, while also reducing the CO2 emissions. So of course, we will have a lot of growth regardless if we deal with the sea element, but if we can deal with the carbon emissions, then it's going to be a destination fuel, not a bridging fuel.
Got it. Jerry, any final comments on this point?
No, I absolutely agree. I mean, between the intermittency of renewable energy, the replacement of higher intensity carbon emissions energy sources such as coal or oil, the hard to decarbonize industries, including transportation and shipping, right, or refineries and whatnot. I mean, there is definitely a place for natural gas and LNG, and hence also if you look at projections, for example, the BP oil review and whatnot, you'll find that in any scenario, even in a more aggressive scenario with regard to the reduction of carbon emissions, still LNG is expected to grow by quite a bit. I mean, BP expects 40% growth until 2030 in terms of LNG demand, and then more like 25% over the subsequent 20 years. So LNG is going to play a major role going forward. Then we will need technological advancements in order to replace it or reduce it. But I think for at least our lifetime, it's going to play a major role in the energy transition.
Okay, before we wrap up, I have one interesting question from the field. And the question is, will there be a natural gas pipeline built from Qatar to Europe?
No.
And does it develop? No, okay. I guess the developments in Syria don't make a difference then because it's not going to get done.
It's being built. It's being built. It's a maritime pipeline made up of a large number of vessels.
Fair enough.
You know, the thing is, the beauty with LNG is its destination flexibility, because you can take that cargo to the market where you get the highest price. If you have one pipeline, you only have one destination and you have one price. So LNG is much more flexible. And as Nicholas mentioned, it's a floating pipeline and you can take it wherever you want.
Well, that was the original intent of the original steam. I mean, the contracts were 20, 25 years and they were floating pipelines. But anyway, we've had a great discussion here. I just want to leave a few minutes before we close about any kind of final thoughts or comments you have on the macro or on your individual businesses within the space. And we'll start with Jerry, and then we'll go to Oystein and Nicholas.
Thank you, Liam, for this and for the very interesting questions. I think I will go back to what I said at the very beginning. Obviously, this is a challenging short-term market, but it is an important market. The silver lining of this is to rationalize the supply. You mentioned it yourself, that it has been coming for a while, the exit of older technology vessels and especially steam turbine vessels. This is the market where we see that cleansing. It's always painful in shipping when it happens, but in a way, this is welcome. And then in terms of the long-term market, especially post the Trump election, I think we are more bullish than ever that we're going to see a tight market ahead. And we are very well placed for this, having brand new ships coming online from 2026, 2027 onwards.
Great. Oystein?
Yeah, no, I agree with Jerry. We have a bit similar strategy. So we have insulated us from near-term weakness with the backlog we have and the cash balance, just the cash balance. We can pay out a quarterly dividend for 3 years and not taking into account the free cash flow from our operations, from our existing contracts. So we're committed to reward our shareholders with a juicy dividend. Hopefully, this market weakness can create some opportunities. The market weakness is always good for the strong companies. Still in shipping, it's a cyclical industry, but we're taking out that cyclicality with our backlog. So we are very well positioned, and I'm actually looking forward to next year to see if there can be some opportunities from this slump.
Slump, okay. Short-term slump. Nicholas, you have the final word.
Thank you very much. And no, I think, it's the same that you're hearing from everybody. We do see, near-term weakness in the market. There might be some opportunities for that. I think we've talked about the major opportunity there, which will be the retirement of certain assets from the fleet that just don't make sense to maintain anymore. It'd be great to see some, well-priced modern assets. I'm not convinced that'll be the case in the near term, because I think the outlook is so positive once we get past the slump that we're in right now.
Great. Well, Jerry, Oystein, Nicholas, thank you so much. This has been a great discussion, and I very much appreciate your time, and thank you for being here.
Thank you, Liam.
Thank you very much for having us.
Thank you, and Merry Christmas.
Merry Christmas too.